Welcome to the Smarter Money Life podcast powered by Forum Credit Union, your go-to podcast for all things personal finance, where we break down complex financial concepts into simple, actionable steps. Whether you're looking to save more, invest wisely, or plan for your future, we've got you covered. Join us each episode as we bring you expert insights, real-life stories, and practical tips to help you live a smarter money life. Hello, everyone. Welcome back to another episode of the Smarter Money Life. I'm your host, Andy Mattingly, and today we're diving into a topic that is crucial for everyone looking to secure their financial future: investing basics. Investing can seem daunting, but understanding the basics can set you up for the path to financial success. So whether you're new to investing or looking to refine your strategy, you're going to love this episode. And I'm very excited today because joining me today is one of our advisors from the Private Client Group, Charles Grigsby, a certified financial planner or CFP professional. So Charles, thanks for joining us today.
Absolutely. Happy to be here. Really excited to talk about this topic.
Good. Well, we're going to dive right in because our audience is used to us getting right after it. So first, I've kind of divided my questions for you in kind of like 5 areas. So the first one is kind of understanding risk. So can you explain why investing always carries risk for our audience out there?
Yeah, absolutely. I think that's a really good place to start because first thing that comes to a lot of folks' minds when they think of investing is the risk associated with it, right? And the way I like to think of it is it's not just investing carries risk, but everything we do in life carries some amount of risk. There's a measured level of risk in just about every decision we make. If you get in your car, you drive to work, you're taking on a level of risk, but you've decided that that level of risk is worthwhile for the goal that you want to accomplish getting to work. Same thing has to be true when we think of our investment strategy. There are certain levels of risk that we're going to have to be comfortable taking if we want to achieve certain goals. And the reason risk exists in its essence is because of uncertainty. None of us know what the future has in store for us. So specifically to the investment world, when I think about risks, I think about, there's no guarantee that when I purchase a specific investment or a specific asset that I can go sell it for as much as what I purchased it for. I have no way to know what the future has in store for a future buyer. Same thing goes if I purchase an income producing asset. There's no guarantees that someone's going to continue to make those payments as they promised me. There are absolutely no guarantees in life, but because there are circumstances that are going to be outside of the investor's control. And that's why risk is inherent in all investing. And one often overlooked thing is the risk of not investing, right?
Yes, that's the thing I think is really important that you just said there too. Of all those things, the risk of not investing is extremely important. What are some of the risks? I mean, you've given us a kind of a high level view. Well, are there any specific risks that you think are kind of common that investors should be aware of? I mean, you named one, not investing at all.
Absolutely, yeah. Just to go forward with that, if you don't invest, then you have taken on the risk of losing purchasing power. Your money is not going to keep up pace with inflation or the cost of goods. We kind of heard inflation in the news a lot lately. I think a lot of people understand how that works. But if you choose not to invest, that's a risk that you're taking on, and you have to be aware of that. Other common risks when they come to investing, and there's quite a few of them, so I'm just going to touch a few bullet points and highlight a handful of them. But one common one we look at is business risk. You purchase a share in a company. Business or management may not be up to par, or maybe competition steps in and takes market share from that business, and that business is no longer profitable. That could be a risk to you as the investor. There's financial risk. They have poor financial practices and their balance sheets are up to par. Maybe they are taking on more debt. That could put you at the risk of default, or maybe they won't be able to make their payments or go bankrupt. So those are some risks. Other ones are industry risks. You've got credit risk, there's legal risk, there's regulatory risk, market risk, interest rates. The list goes on and on and on. There's quite a few of them. But understanding those risks can help you make your investment decisions. There's definitely ways you can mitigate and control the way you expose yourself to those types of risks.
Yeah, that makes sense. And I think kind of the next thing we're diving into is kind of this importance of diversification, which I'm pretty sure you're going to tell me that's the way investors can mitigate those risks. So let's talk a little bit about diversification, why it's important. Can you give some examples and how that helps with mitigating risks?
Yeah, absolutely. Diversification is crucial. It is probably the easiest way for an investor to control the amount of risk that they're taking on. I've all heard the saying, you don't want to put all your eggs into one basket, right? If you put all of your resources into one company or one entity or issuer, and something goes wrong that's outside of your control, maybe even outside of that entity's control, you put yourself in a really risky position. When you diversify, you limit that type of risk. Some of those earlier risks that I mentioned, the business risk, financial risks, those are unique to an individual corporation. And if you spread your investments around among many different companies or many different entities or different types of investments, you can almost mitigate that risk entirely, because when one company fails or one investment goes under, you're not entirely exposed to that, and your entire portfolio is not going to be hurt in that situation.
Yeah, and so you've talked just a little bit about this already, but do you have, like, if someone's out there and saying, well, I have a portfolio, what's an example of how someone can diversify their portfolio? Do you have kind of an example of, hey, this is a generally good diversified portfolio?
Yeah.
And we're not giving investment advice.
No advice, yeah.
We're just giving
education.
Some education,
exactly,
yes.
Exactly, with the disclosure there. Well, there's a couple ways you can diversify, right? So simply put, diversification is having your dollar spread across multiple companies, entities, industries, countries. It sounds kind of complex, and it'd be hard for the individual investor or just, your regular person just to go out and make those decisions. It's a lot of research and work. What the industry has come up with, or the financial industry has come up with, is things called mutual funds and ETFs. And these are really easy ways to instantly diversify your investment portfolio. You put $1 into a mutual fund and you buy a basket of goods, a whole lot of different companies, a whole lot of different bonds, hundreds, sometimes thousands, tens of thousands of investments with one single purchase. And that's one really easy way that the average investor can diversify their portfolio.
Yeah, that's good. So going to move from diversification to kind of the advantages of starting early. What do you try to tell younger people why it's important to start early with investing, saving in their 401k or even outside of it if they don't quite have opportunities for that yet?
Yeah. Starting early is crucial. This is a topic I love to talk about because the power of compound interest is just so compelling. And I'm going to share some numbers with you here in a moment that'll kind of help drive the point home. But Albert Einstein called compound interest the eighth wonder of the world, right? And for good reason. The earlier you start, the more time you have to compound. And time is your greatest ally when it comes to investing. I'm going to give you an example here because we all kind of know that we should let our money compound. We all know the power. We've heard this before. But until I heard figures, it didn't really resonate with me. So hopefully the audience can get some takeaways as well. So if you started at age 20, you put $1 away into an investment that got 10% annualized return, and you didn't touch it, you didn't add anything else to it, by the age 65, when you pull that out, that investment is going to be worth $73. It's a 73-time growth rate on that dollar. So we're talking a dollar. Imagine $10,000. That's $730,000 just for putting 10 grand away. That's how powerful.
One time.
Yes.
One time.
Now, if you delay and you push snooze on that and you want to wait till you're 30, because let's be honest, our 20s are busy. Most of us weren't making any money in our 20s. There's not a lot of discretionary income. We maybe are starting families, and a lot of people wait a little while to get started. Say you wait till you're 30 to put that $1 away. Well, instead of having 73 at retirement, you would have a total of $28. That's a huge difference.
And it's just 10 years.
It's just 10 years difference. Now, if we push snooze on that one more time and we wait until we're 40 to start, you're looking at that $1 being worth $11. So you could tell a major difference between $73 and $11. Just a couple of decades can make a huge difference. And that's all based on that power of compounding interest.
Yeah, that is the thing I think that resonates with people once they hear those numbers. And I appreciate you putting it in a simple number, just $1.
Yeah.
That's really good. So, some people have waited till late. So what do you tell them if they say, it's just too late for me to do this. I'm just going to have to work the rest of my life. And they're in their 40s or 50s. What advice do you try to give to people in that situation to say, well, here's how you're not going to you can't get back time, but here's some things you can do to try to help yourself. So what do you try to tell people that feel like that it's too late type of thing, with basically saying it's never too late?
Yeah, absolutely. And that's a lot of people. That is a lot of people who are in that position. Life is busy. It's hard to start early. I use those numbers above, and somebody might hear them and say, well, I didn't start in my 20s, so what's the point, right? Why even begin now? Well, first of all, I want to give a little perspective. An 11-time return, 11x return on your investment at age 40, still pretty darn good.
Yeah.
It's not as powerful as it is in your 20s. And you could do it really easy in your 20s, saving small amounts of money and make it really easy. But if you start later, you're going to have to just work a little bit harder. You're going to have to save larger dollar amounts if you want to make sure your retirement or your financial goals come to fruition. Now, it's never too late. I would say, I liken it to kind of your physical health. Just because you found yourself in a situation where maybe you have had bad habits, whether they're dietary or exercise, and later in life you want to make a change, should you just not do it because you neglected those things when you're? Absolutely not. We would never say that.
Yeah.
So the same thing should be about your financial health. There's never a time that is too late to start. The more you start now, the more you're going to be serving yourself in the future.
Yeah, that's good. And that is so important, is that it's never too late to start and you can always make a difference. I'm going to switch gears on you a little bit now, and I want to talk about why, the long-term perspective is so important, because you have some people that have been investing and they love to look at their 401k every day and they like to do those types of things. So let's talk a little bit about that, why it's important, and, how to manage fear, because people will have fears when they see things go up and down. So let's talk a little bit about this long-term perspective that we all have to put in, kind of start using.
Absolutely. So the most important thing I want anyone to take away from this conversation, I think, is that investing takes patience. It takes patience, it takes time, and it takes resilience, because there are going to be scary moments in your investing experience. We've all been through it. If you've been investing in anything, we saw COVID happen, right? And we saw portfolios drop by large percentages. The housing crisis, the dot-com bubble. There's always going to be something that disrupts markets and makes things scary. And it's always going to be new. And that's what's the scariest thing about it, is because it's very easy to make emotional decisions, because the new information is hard for us to process sometimes, and we want to protect ourselves. It's a natural instinct, right? But it's so imperative to keep an eye on the long run. It's very easy to get distracted by some of that short-term volatility, but I want to share some more numbers with you, if you don't mind.
Yeah.
That maybe helps put some of this stuff into perspective. If you look at the U.S. stock market, and I'm using the S&P 500, for example, if you don't know, it's just 500 large companies in the United States. And a lot of people use that as a barometer for what the stock market's doing. And if you look at that from 1950 to 2021, and you put all of those returns every single year up on a board and you threw a dart on it and you just picked a random year, in that random year, you could be up as much as 47% or down as much as 39%. Pretty big swings, right?
Yes.
Yeah, right?
Very big.
That's just a 1-year period. But if you extrapolate that out a little bit further and you do a 10-year rolling period, 10 consecutive years, any 10 years consecutive in that time frame, well, then now your worst outcome you would have possibly had would be minus 1%. Much better outcomes than what you saw as minus 39%, right? In a 1 year.
Yes.
Push that out a little bit further. If we look at a 20-year period, the absolute worst outcome you would have had during that time period would be positive 6%. That's pretty nice. And then that's not to mention the best thing you could have had during that time period. The best 20 years, you would have left with up 17%.
Yeah.
So the longer your time horizon, the longer you're able to stay patient and not make knee-jerk reactions, the better your outcomes are going to be. And I want to share one more fun story that a lot of people don't realize. Warren Buffett, billionaire, brilliant investor, right? Worth $114, $115 billion or something, like probably more than that now since I looked at it. 99% of his wealth came after the age of 50. And there's been studies done that if he had not started so early and then continued so late, I mean, he's in his mid-90s now and he's still investing. Yes. If he had just started in his 30s and stopped at his at age 60 and retired, his returns would have been, his total portfolio would be at 11 million as opposed to the $114 billion. So that just shows how a long-term perspective can really give you a lot of power.
Yes, yes. And, I think it's all the technology and up-to-date information is great. But I remember when I started with my 401k, we got quarterly statements. You had no idea what you were doing, but actually it was probably good because during that quarter, things were up and down. Mm-hmm. But at the end of the quarter, it was always, you never were very much. And I think today, with all of our investors, everything's at your fingertip. You can look this morning, you can look at every hour to see what your portfolio is doing. And I think that is, an issue. So, just, share with our audience why it's so important not to react to short-term changes in the market.
Yeah, I agree. Just to piggyback off of what you just said about checking statements regularly, that's one of the ways you can stay focused on the long-term picture. You don't want to be logging into your portfolio every single day, especially, you're 20 years, 10 years out of retirement. It doesn't really matter what happens today. And focusing on that's just going to cause a panic reaction. That's one of the many ways you can kind of stay focused on the long term. Another way you can stay focused on the long term is to have a very healthy emergency fund so that when things do turn sideways, then you don't have to worry so much about your portfolio being down because, if you have a personal crisis, maybe it's a healthcare bill, maybe it is a co-payment on a insurance policy or something like that, you lose your employment. If you need access to some money, you don't want to have to lean on your investments because that could coincide with a downturn in the market. If you have a nice, healthy emergency fund, all the intermediate volatility, the short-term volatility, it's irrelevant because you're not touching that for long-term. So having a good emergency fund that you can lean on somewhere safe that's not going to lose any value. Put it at your credit union. Put it into a CD or into a money market instrument that it's going to be protected and safe. And that way you can have a lot of peace of mind.
Yeah, that's really good advice. So I want to kind of end with just kind of getting back to some basics and helping people understand, that when you're getting into investments, there can be investment costs. You talked about ETFs and mutual funds. So can you talk about some of the common fees? And then if you're investing outside of tax advantage, what taxes can be associated with that? Just kind of give some of our, new investors out there things to look for. So just to kind of put a bow on all of these things, if we've got them convinced they need to do this, maybe that final thing is, what are some of the things they should be looking out for?
Yeah, taxes and fees. How much time do we have left? We'll just touch on a few of these things, but it can be rather complex. So we could do a whole podcast just on the fees and taxes and all the nuances of investing and the costs that are associated with it. The things that investors should look for are the management fees. That's one thing that you'll see common. So management fee might be what you pay for a financial professional to manage your portfolio and give you other ongoing financial planning advice. There's also mutual fund fees, expense ratios. So these are fees that the mutual fund company charges the investor, and that's how they pay for their research. That's how they pay their portfolio manager and do their marketing and whatnot. But it comes away from your returns, right? So you got to be cognizant of this because as fees chip away at your returns, as powerful as the compounding is to help you grow money, the fees can compound and retract from your goals as well, or detract from your goals as well. Other fees you might see are commissions. Those are really common in insurance products, but there's certain mutual funds that would carry commissions at sale or at redemption. So knowing what fees are involved in the investment you're looking for are really important. And the best thing you could do is ask a lot of questions to whoever's providing you the service. There's lots of disclosures out there, and there's lots of consumer protection to help you be aware. But it is a little bit complex, and some people just want to put that pile of paper aside. So it's important if you're doing this on your own, you got to read the disclosures. You got to read up on the fees if you're doing this on your own. As far as taxes are concerned, common taxes you'll see, in a retirement account, mostly you're just going to look at income tax as you do withdrawals. You might get penalties if you take things out early. There's certain tax-free retirement accounts, Roth accounts that are really nice. So you have already been taxed on the money you put in, and then you don't have to worry about any taxes going forward. But in your standard brokerage account that's not in a retirement account, you're going to be seeing things like capital gains fees. You're going to see income and distributions like that are going to be taxable. And those types of taxes you'd be paying year over year. So you're going to want to be aware of kind of what kind of activities going on in the account, because that's what drives a lot of the tax ramifications on an account like that.
Yeah, that's a good point. And one thing I want to talk about, and I mentioned this when I introduced Charles, that he's a certified financial planner. Whenever you're doing investments, one of the things, and I'll let Charles talk a little bit about this, but I want to set it up so that you all don't think it's a self-plug for him. But being a CFP means that you have certain standards that you have to meet, and you want to look for someone that has that. You want to look for someone that is registered with FINRA, even if they're not a CFP. So you want to do all of those things with the research, because these things that we're talking about with costs, people that are registered with FINRA, when you're looking for a broker in that, they have to disclose all of these prominently. They can't just hide it from you. And I think that's one of the things that when people get into investing, they need to know. And I'm saying all that because one of the things that they can also look at is if they're investing and they have their own brokerage, and I just want you to talk just a little bit about this, is that if you have a taxable account, there are things that you can do to mitigate your tax bill at the end. The generic term is tax loss harvesting, but that is a strategy that if you're working with someone, you want to make sure they're doing. And you can maybe explain a little bit about that if you want.
Yeah. Let me address a little bit of some of the earlier stuff you said on that, because I think that's super important, and I want to drive that point home. Not all financial advisors are the same. A lot of people can call themselves a financial advisor, but you might be working with an insurance broker. You might be working with a retirement plan specialist. You might be working on investment manager. There's a broker dealer. There's a whole lot of different people that would call themselves financial advisors. But you want to make sure that you understand what their interest is. And working with somebody who is a fiduciary is something that I would definitely recommend. That's not to say that just because someone is not a fiduciary and they're selling a commission product, or they have self-motive that that's a bad product or they're a bad person, there's a place for that. But the consumer just needs to be aware of who they're working with. And I think asking those questions and really not just settling on the first person you sit in front of is crucial when it comes to picking someone to partner with for your financial planning. But on that note of tax loss harvesting and ways to manage a taxable account, yeah, absolutely. That's a strategy that you can utilize in order to help mitigate your tax bills. Essentially, what that means is if your account has losses, and without getting too far into the weeds, a loss is basically you buy an investment and then it's not worth as much as it was when you purchased it. So you buy XYZ stock at $10, it's worth now $8. Well, if you sell it, then you have a $2 capital loss. And it depends on whether you held it for a year or less, or a year or more, I should say, whether it's a long-term or a short-term capital loss. Either way, you can take those losses against capital gains, or you could take them against ordinary income, depending on your situation. And that's a way you can mitigate your income tax bill at the end of the year, and being cognizant of where your portfolio is at, especially as you roll around that December 31st deadline. We do a lot of looking into accounts to see where there's opportunity to harvest losses and offset other income sources.
Yeah. Well, Charles, thank you so much for sharing your insights today. And we covered a lot of things. Is there any final thoughts you want to give to our audience here before we wrap up?
Yeah. One thing I would say, if you're new and getting started and you need a place to go as a new investor, the best resource you have often is your employer. A lot of employers have really good resources out there, and a lot of them have retirement plans. If you're lucky enough to be a participant in a 401k plan, you can get company match from your employer. You can get educational services a lot from your employer. There's so many resources out there for you if you are in a company like that. But if you're not lucky enough to have that, talk to your local credit union, talk to a bank. There's financial coaches out there that can help guide you through this journey, that can do it for a really reasonable amount and help you get on track, because it can definitely be overwhelming. And it's easy to say, go do your own research, go jump on Investopedia or start Googling things. Your head will start spinning so quick you won't even know which way straight. So it's good to have dependable resources that you can lean on to guide you through your specific situation.
So just to wrap this all up, What we've learned from Charles today is that investing is a journey and it requires patience, requires knowledge, and a strategic approach. So remember, investing always carries a risk, but with the right mindset and tools, you can navigate these challenges and work towards a secure financial future. That's all for this episode of the Smarter Money Life podcast. Thank you for joining me. I hope you found our discussion helpful and inspiring. You can find more resources on the Smarter Money Life page at forumcu.com. Remember, making smart financial decisions is a journey, and every step you take brings you closer to your financial dream. Be sure to tune in next time for more tips and insights on managing your money. Until then, stay smart and financially savvy.